It's a normal morning on the 42nd floor of a midtown Manhattan skyscraper, right up until the elevator opens. 4 human resources executives step out, carrying empty file boxes. Everyone on the trading floor knows exactly what that means. They split up, hunting specific names. Their top target is Eric Dale. He's been at the firm for 19 years as the head of risk management. His entire job is to measure exactly how much financial danger the company is in at any given moment. Within minutes, they fire him, sever his email access, and kill his phone lines. But as he's being escorted out the door, Dale pulls a single USB drive from his cardboard box and hands it to a 27-year-old former rocket scientist named Peter Sullivan, telling him to be careful. Peter has no idea, but he's holding a digital detonator. The data on that tiny piece of hardware is about to blow a hole in the global economy, and the clock is ticking on a 24-hour countdown to total collapse. At 10:17 p.m., the floor is empty. Peter sits alone in the dark, running the data on Dale's drive. What he finds hidden in the firm's books is a catastrophic mathematical hole. To understand what he's looking at, we have to step out into the real world. For years, American banks had been feeding a national obsession with homeownership by handing out massive mortgages to almost anyone who asked. This document shows exactly what they were approving. Notice the high interest rates and steep fees on these mortgages. The industry called them ninja loans. No income, no job, no assets. A strawberry picker earning $15,000 could easily get a $720,000 home loan. The banks didn't care if the borrowers could actually pay them back. Their business model was simple: originate the garbage loan, collect the fee, and immediately sell the debt off to someone else. That brings us back to Peter's screen. The firm's books are poisoned. The foundation of their massive wealth is built entirely out of loans, mathematically designed to fail. Fast forward to midnight. The firm's top executives descend on the building by helicopter. The CEO demands the young analyst explain the crisis to him, as if speaking to a golden retriever. Peter explains the firm's main product, mortgage-backed securities, or MBS. Wall Street would take thousands of individual toxic mortgages and bundle them together into a single massive financial product. Think of it like a sausage. This diagram shows how the trick worked. By grinding questionable ingredients together, the banks disguised the risk, slapping a fake AAA safety rating on the final package. That rating tricked pension funds and global banks into buying them as if they were perfectly secure. But there's a logistical bottleneck. It takes about a month to package all those loans. During that time, the firm has to physically hold the toxic assets on its own books. To maximize profits, the firm pushed its leverage to the absolute limit. They borrowed astronomical amounts of cash just to buy more raw mortgages, eventually holding a staggering $1.2 trillion in toxic assets. Because of that massive leverage, the math turns deadly. If the value of those assets drops by a mere 25% while sitting on the firm's books, the resulting loss will exceed the total value of the entire company. The music has officially stopped.
So how does a building full of highly paid mathematical geniuses fail to see a trillion-dollar hurricane heading straight for them? They were relying on something called the value at risk, or VAR, model. This is the banking industry's standard tool for measuring danger, essentially functioning as a weather forecast for money based on historical data. This chart highlights the fatal flaw in their logic. The model looks at decades of history and predicts your worst losses based on 99 days of normal market behavior. It makes you feel completely safe, entirely blinding you to that 1% catastrophic outlier. The second failure was the assumption of independence. The math assumed a homeowner defaulting in Ohio had nothing to do with a homeowner defaulting in Florida, but the housing bubble tied them all together. When one fell, they all fell. Peter realized the extreme market volatility over the previous 2 weeks had already shattered their historical predictions. The 1% hurricane wasn't coming. It was already here, and their math was entirely useless. The CEO makes a brutal choice for self-preservation. To survive, the firm will sell its entire $1 trillion portfolio of worthless paper the second the market opens, completely destroying the buyers who trust them. At 7:30 a.m., the trading floor is dead silent. The head of trading instructs his team to liquidate every single cent before the closing bell. If they hit their targets, they each walk away with a $1.4 million personal bonus. The great betrayal begins.
These traders start dialing their closest friends and former college roommates, dumping toxic assets onto their balance sheets under the guise of giving them a friendly discount. As the morning drags on, the asset prices begin to implode. They start selling at 96 cents on the dollar, but as buyers hesitate, the price craters to 85 cents, then 73, and eventually down to 64. By mid-morning, the secret leaks. The street figures out they aren't looking at a normal trade. They are watching a desperate, full-scale liquidation, and the panic sets in. By the final bell, the firm has offloaded nearly everything. They successfully saved themselves from immediate bankruptcy, but they deliberately detonated the global market to do it. Everything that played out in that fictional boardroom happened across every major bank on Wall Street in September 2008. The macroeconomic fallout was immediate. Mortgage rates doubled overnight. Safe pensions, packed with those fake AAA sausages, lost 40% of their value, and $11 trillion in global wealth evaporated. Entire neighborhoods physically changed. Vibrant communities turned into abandoned ghost towns, with empty dirt lots sitting where homes were supposed to be built. 6 million families were forced out of their homes. Welcome mats were quickly replaced by foreclosure signs. Then came the ultimate insult to the public. As the world burned, the government stepped in and wrote a $700 billion check to bail out the exact same institutions that engineered the crisis in the first place. The financial system didn't break in 2008. It functioned exactly as designed. It's a cynical cycle where the executives at the top cash their bonuses and escape accountability, leaving the rest of the world to absorb the blast.